Have you ever noticed how the same conversation happens every time the market drops? Everyone suddenly becomes an expert on what they should have done 6 months ago. They talk about timing, about getting out early, about seeing the signs. But here's what nobody mentions in those conversations. The people who actually made it through weren't the ones who predicted the crash. They were the ones who owned things that didn't need prediction to work. My name is Anderson, and I want to show you something that most investors will go their entire lives without understanding. There's a pattern that repeats itself across every major financial collapse in modern history. 1929, 1973, 2008, 2020, and what happens every single time is this. While most portfolios are getting destroyed, a small group of assets quietly hold their value or even grow. Not because of luck, not because someone got the timing perfect, but because of something deeper about how these assets function during chaos. And here's the part that should bother you. Almost nobody owns them beforehand. Think about what that means for a second. We have 100 years of data showing exactly what survives when everything else is falling apart. And still, fewer than 5% of investors position themselves accordingly. Why? Because these assets don't show up in the financial media hype cycle. They don't promise quick returns. They don't have the exciting story that gets clicks. They're boring until they're not. Let me paint you a picture of what actually happens during a collapse. When the market starts falling, the first thing that goes is confidence. Not money yet, confidence. People stop believing that tomorrow will be better than today. And once that belief cracks, everything changes. Suddenly, every financial decision becomes about protection instead of growth. You stop thinking about building wealth and start thinking about not losing what you have. And that shift, that psychological shift from expansion to contraction, that's what destroys most investors. Because here's the thing, when you're operating from fear, you make fear-based decisions. You sell at the bottom because you can't stand watching the number go down anymore. You pull out of positions that would have recovered because you need to feel like you're doing something. You chase safety in all the wrong places because panic doesn't have time for strategy. And by the time things stabilize, you've locked in losses that didn't need to happen. Now compare that to someone who owns assets that fundamentally behave differently during chaos. They're not watching their portfolio trying to decide when to sell. They're not refreshing their brokerage account every hour wondering if today's the day it all falls apart. They're calm, not because they're smarter or braver, but because what they own doesn't require them to be right about timing. It just requires them to wait. That difference in mental state is everything. Let me show you what I mean with actual numbers. During the Great Depression, the stock market fell 89% from peak to bottom. 89%. If you had $100,000 in stocks in 1929, by 1932, you were looking at $11,000. Most people never recovered from that psychologically, let alone financially. But here's what almost nobody talks about. Gold mining stocks during that same period went up nearly 500%. 500. While everything else was collapsing, a specific category of assets was multiplying wealth. Or take 2008. The S&P 500 dropped 57%. Retirement accounts got cut in half. People who were 2 years from retiring had to keep working for another decade. But long-term treasury bonds during that crash, they went up, not a little, double digits. While stocks were in free fall, a different asset class was actually making money. Now, here's where most people get it wrong. They hear stories like this and they think, okay, so I should just own gold stocks and treasury bonds and I'll be fine. But that's not the lesson. The lesson is about understanding what you own and why it behaves the way it does. Gold mining stocks went up during the Depression because gold became the only thing people trusted when paper currency and banks were failing. The fundamental demand for gold surged while production costs stayed low, so mining companies printed money. Treasury bonds went up in 2008 because when everything feels risky, people flood into the safest asset they can find, which is US government debt. These weren't lucky bets. These were structural realities playing out exactly as they always do during a crisis. And here's the invisible threshold almost nobody crosses. It's the moment you stop building a portfolio based on what's exciting and start building it based on what's resilient. Most investors never make that shift. They spend their entire lives chasing returns, comparing themselves to whoever made the most money last year, jumping from trend to trend. And when the crash comes, they're completely exposed because nothing they own was designed to survive bad times. It was all designed to maximize good times, and good times don't last forever. But the people who cross that threshold, who build for resilience first and growth second, they experience the exact same market crashes in a completely different way. The same event that wipes out their neighbor's retirement account becomes a minor inconvenience for them, not because they're lucky, because they built a foundation that doesn't crumble when things get hard. Let me tell you what that foundation actually looks like. First piece, essential consumption. Think about what people need versus what they want. During a depression, luxury spending dies. Travel, entertainment, expensive dinners, new cars, all of that evaporates. But people still need to eat. They still need basic medicine. They still need soap and toothpaste and electricity. So, companies that produce essential goods don't see their revenue disappear. It might slow down, but it doesn't vanish. And during 2008, while the overall market dropped 57%, consumer staples stocks dropped less than 20%. Still down, but recoverable. And they came back faster than everything else because demand never truly left. Second piece, productive land. Not real estate speculation, productive land. Farmland specifically, because no matter what's happening in the economy, people need food. And farmland generates income whether the stock market is up or down. During the Great Depression, people who owned farmland didn't get rich, but they survived. They had food. They had something to barter. They had tangible value when paper wealth was worthless. And over the long term, farmland has preserved purchasing power across generations because it produces something fundamentally necessary. Third piece, government debt. I know this sounds boring, maybe even stupid. Why would you lend money to the government at low interest rates when you could be making big returns elsewhere? Because during a collapse, elsewhere doesn't exist anymore. When everything is falling, the only question that matters is, what will still be here when this is over? And US? Treasury bonds represent a bet that the US government will still exist and still honor its debts. That's not a flashy bet, but it's a bet that has never been lost in the history of this country, and when panic is everywhere, that certainty becomes incredibly valuable. Fourth piece, monetary metals, gold and silver, not because they're magic, because they're the ultimate store of value when confidence in everything else breaks down. Gold doesn't care about interest rates or earnings reports or economic growth. It just sits there being gold. And when people stop trusting banks, currencies, and governments, they flood into the one thing that has held value for 5,000 years. You don't own gold to get rich. You own gold to stay whole when everything else is breaking. Now here's the psychological shift that has to happen for any of this to make sense. You have to stop measuring success by how much you made last year and start measuring it by whether you'll still be okay when things go bad. That's a completely different game. Most people never make that shift because it feels like giving up on growth, like you're being too conservative or too scared. But it's not about fear. It's about understanding that wealth is only real if you get to keep it. Think about it this way. If you make 30% returns for 5 years and then lose 60% in year 6, you're down overall. You didn't build wealth. You rode a wave and then got crushed by it, but if you make 10% returns for 5 years and only lose 15% in year 6, you're still ahead. It's less exciting, but it's real. And it compounds over time without the catastrophic setbacks. The people who own these hidden assets aren't trying to beat the market. They're trying to outlast the market, and that requires a completely different mindset. Here's where the identity shift happens. You stop being someone who reacts to markets and become someone who structures around them. You stop asking, what's hot right now? And start asking, what will still matter in 10 years? You stop comparing your returns to your coworkers' tech stock gains and start comparing your stability to your own peace of mind. And once you make that shift, opportunities start looking different. When everyone else is panicking about a recession, you're looking at which essential goods companies are undervalued. When interest rates spike and bonds sell off, you're looking at locking in higher yields for the next decade. When farmland prices drop because credit is tight, you're looking at acquiring productive assets at a discount. The same events that feel like emergencies to most people feel like opportunities to you. Not because you're smarter, because you're positioned differently. Let me show you what this looks like in practical terms. Let's say you're 40 years old with $200,000 invested. Traditional advice says put it all in a broad stock index fund and let it grow for 25 years. And in a world where markets only go up, that works great. But we don't live in that world. We live in a world where every decade or so, something breaks. And when it breaks, that 200,000 can easily become 100,000. And if you're 62 when that happens, you don't have time to wait for the recovery. Now, imagine instead you split that 200,000 differently. 60,000 in treasury bonds, 40,000 in a basket of consumer staples stocks, 50,000 in a farmland investment trust, 30,000 in physical gold, 20,000 in cash. It's not as exciting. In a raging bull market, this portfolio will underperform. But when the collapse comes, this portfolio doesn't collapse with it. The bonds might go up, the staples might drop, but not catastrophically. The farmland keeps generating income, the gold holds value, and the cash gives you the ability to buy whatever got unreasonably cheap. Over 25 years, you might make slightly less in the best case scenario, but you'll make significantly more in the realistic scenario where at least one or two crashes happen. Because you won't be the person selling at the bottom trying to stop the bleeding. You'll be the person who stays calm because nothing you own requires perfect timing to work. That's the real edge. It's not about being right. It's about not needing to be right. Now, let me give you the warning that nobody wants to hear. These assets are not magic. They don't guarantee you'll get rich. They don't protect you from every possible outcome. What they do is change the odds. They tilt the probabilities in your favor over long periods of time across multiple economic cycles, but they require patience. They require you to accept lower returns during the good times in exchange for stability during the bad times, and most people can't make that trade. Because here's what happens. You build this resilient portfolio, then your friend tells you about some stock that doubled in 6 months, and suddenly your 10% annual return feels pathetic. You start questioning whether you're being too conservative, whether you're missing out. And that voice, that fear of missing out, that's what breaks people. They abandon the strategy that would have protected them because it feels too slow, and then when the crash comes, they're right back where they started, exposed and scared. So the real question isn't whether you understand these assets, it's whether you have the discipline to own them when they're boring. Here's the thing about opportunity cost that nobody explains properly. Every dollar you spend on something that doesn't hold value is a dollar you won't have when value becomes scarce. That fancy car you financed, that bigger house you bought to impress people, that lifestyle upgrade that felt justified because you got a raise, all of that is money that won't be there when you need it most. And the tragedy is, you won't realize it until it's too late. I'm not saying don't enjoy your life. I'm saying understand what you're trading. When you spend an extra $50,000 on a luxury vehicle instead of putting it into resilient assets, you're not just spending $50,000. You're spending what that $50,000 would have become over the next 20 years. You're spending the security it would have provided during the next downturn. You're spending the options it would have given you when everything around you is contracting. That's the real cost, and most people never calculate it. So here's what I want you to take from this. The next financial collapse is coming. I don't know when. Nobody does. Could be next year, could be 10 years from now. But it's coming because it always comes. The economic cycle has never been eliminated, only delayed, and when it arrives, you will either be someone who survives it or someone who gets destroyed by it. And the difference won't be luck. It'll be what you owned beforehand. The people who make it through aren't the ones who predicted the crash. They're the ones who didn't need to predict it because they built a foundation that works in any environment. They own things that people need during chaos. They own things that governments back during panic. They own things that have held value across centuries. And they own enough of these things that when everything else falls apart, they're still standing. You have time right now to become that person. Not a lot of time, but enough. Enough to shift some of your portfolio away from pure growth and toward resilience. Enough to buy some treasury bonds or farmland or gold before you actually need them. Enough to build a foundation that doesn't require you to be a genius or a market timer or lucky, just someone who learned from history. And 20 years from now, when you're sitting somewhere peaceful, watching some new crisis unfold on the news, and your portfolio is fine because you built it to survive exactly this, you're going to remember this moment. The moment you decide that protecting what you have matters just as much as growing it. The moment you stopped chasing excitement and started building safety, and you're going to be so grateful you did. My name is Anderson. Thanks for listening, and I'll see you in the next video.